And welcome to my channel. For those of you new, my name is Dave and I work in financial services, and these videos are a mixture and journey towards financial freedom, financial well-being, financial products, so you, like me, can reach your goals sometime in the future. Now let's get into the latest video. Now I do have a workplace pension, but I'm obviously restricted through auto-enrollment, size of contribution I can make, and the funds or investment I can hold. So I do my own self-invested personal pension plan. So this is a review for November 2024. Now, it's not to boast or brag, say, look at me, but it's to give people hope and ideas. If I can build a size worth over six figures, you can too. If you create a plan, think long term, and get investing on a regular basis. So, what are the aims of the portfolio? Well, we're looking for yearly growth of 10%, dividends this year of £5,500, and a year-end valuation of £117,000. How have we done the month? Well, a very good month. We started at 132,495. We finished at 136,534. So a profit in the month of £4,039, and year to date we're up 22.1%. So well above expectations. Now we normally put £250 a month first of each month as direct debit, automated savings, and the government will give us tax relief of £62.50. Predominantly based, shall we say, in the UK, and financial services is what we know about. Quick look at the graphic. So we say platform charges of £16.96, which is our average based upon the size of our portfolio. It's the percentage charged by our platform provider. So where are the funds held? Well, at the moment, 77% in UK, nearly 21% in USA and Americas, and 2.28% in Asia and emerging markets. Now, not the greatest of the month for dividends, but one dividend of the month. Following graphic, AG Bar, the platform provider, gave us £5.64. Now, across our shares, our 15 shares, we've got an average yield of 5.05%. We'll have good months, we'll have bad months. Look at the following graphic. But year to date, we expected £5,041. And we're at 5393, so we're £351 better than when we expected. And we will have some very good dividends during December. BP, Shell, HSB, CC and Sainsbury's, to name a few. So where exactly are the funds or the shares held within the portfolio? Well, let's dive in a little bit deeper. Remember, they're my own personal opinions. If you like videos, smash the like button, subscribe to the channel. Now let's look at the portfolio. Two funds, quite simplified. Our funds make up 27% of the portfolio, both in profit. Collective fund value of just over 37,000. Now we own a Fidelity World Index fund, nearly £20,000, 14% of our portfolio, very low fees of 0.12%, and it currently owns just over 1,400 shares. We just switch off, covers the market, but it's given an annual return around about 8-9% for the past few years. We've done it for diversification originally, but it's got low fees and we've got a very good track record. Our other fund we owned is an LNG technology fund. Technology's had a very good run lately. We own £17,000, nearly 13% of the portfolio, slightly higher fees of 0.32%, and a much smaller holding of 253 shares. But again, some very good results lately. Just switch off, does what it says in the tin, but it was done again for diversification. So two, shall we say, well-established funds, just there sitting in the background. And we have topped up our fund, Fidelity World Index, £400 a month from contributions, tax relief, and some small dividends we received. But again, it will all be reinvested back into the portfolio to increase the value at a later stage. And moving forwards, we are going to top the Fidelity World on a regular basis because we're trying to, shall we say, get away from the UK markets because of percentage value. Now let's look at what sort of shares we hold within the portfolio. If we look at the following graphic, shall we say, 73% of our portfolio is in shares, 63% in the FTSE 100 and 10% in the FTSE 250. 15 shares, 12 in profit, 3 in loss, but it makes up £99,448 within the portfolio. And with regard to most of the shares, all dividends are reinvested to, shall we say, accumulate growth moving forwards. Our largest holding is Aviva, 4,983 shares, £24,000, 17% of our portfolio. Very good, nice yield of about 8-9%. Has just made a bid, shall we say, for direct line. So see what happens about how they overpriced, how it affect the share price. But shall we say, it's on the acquisition trail again. We own Lloyds, the banking group. Nearly 37,000 shares, £19,500, 14% of our portfolio. Has struggled lately, shall we say, because of the so-called car finance scandal or recent court case. Be interested to see what happens about compensation in the future. But a very good company, very cash rich, a yield around about 4-5%. We own HSBC, 1,244 shares, £9,200, 6.7% of our portfolio. Shall we say, done for diversification, although it's UK listed, mainly based, shall we say, China and South America, but it will give a nice quarterly dividend payable within December. Now, away from the banks, we own Drax, the biomass oil polymer producer, 304 shares, £8,500, 6.3% of our portfolio, but very cash rich, does give us a very nice yield and a long-term buy. Back on the banking sector, we own Barclays, 3,212 shares, £8,500, 6.2%, but a very good run recently, and again, very cash rich, very nice dividends. Away from the banks, we own Greggs, the retailer or the baker, 292 shares, £8,000, 5.8%, but very cash rich, is on expanding spree, mainly away from the high street, but more, shall we say, forecourts, service stations, retail outlets. And it has done, shall we say, extended hours, done kind of late night evening menus and an early breakfast menu, but very cash rich. Okay. We own L&G, the insurance company, 2,248 shares, £5,000, nearly 4% of our portfolio, but a very nice yield of nearly 9%. Just like Aviva, just switch off, does what it says in the tin. Everyone needs insurance. We own Sainsbury's, the retailer, 1,291 shares. Has had a very good run lately, £3,500, 2.4%, but again, will give a very cash-rich dividend in December, and hopefully we'll have very good trading statements over the festive period. Now, away from the banks, we own Shell, nearly £4,000, 3% of our portfolio, and BP, £2,000, 1% of our portfolio. But again, very quarterly dividend payable in December, shall we say. Just reinvest, shall we say, within other holdings because the dividends are small, but it's a form of cash flow. We also own, shall we say, other companies of JD, £2,500 or 2,500 shares, £2,500, 2% of our portfolio. It is very cash rich. It makes about £1 billion of profit, one of the very companies that does, but it has struggled lately, shall we say, from a poor trading statement within the Americas. But it's what we call as a growth stock. Now, other companies we own, shall we say, is AJ Bar, the drink provider, AJ Bell, the platform provider, Card Factory, the retailer, and Pennon, the water company, which has struggled, probably our worst performing share to date. But results out recently will give a very nice dividend in April next year. Now remember, they're my own personal opinions, okay? But it just goes to show, if I can build a portfolio over 6 figures, you can too. If you invest on a regular basis, say we're putting $250 a month, but it's a long term, it's not a get rich quick scheme. But if I can do it, you can do it. Remember, if you like the videos, smash the like button, subscribe to the channel, and we'll see you again in the next video.